Good morning and welcome to this Wednesday, June 1st, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it is June 1st, a new month. It's hard to believe 5 months already gone in 2022. Heading into the warmer months, I can tell you it's been a steamer here down in South Carolina recently. Just a reminder that summer is here and spring is over for the most part. Hopefully we'll still have some nice spring days. But yeah, things have really heated up here. Things have been heating up pretty good in the market too, but I don't know how much it's going to last. Got definitely a couple of warning signs starting to, show their face yesterday and here just recently. So we'll see whether or not we can continue to hold on to these to this nice rally that we've got going. Futures are pointing up, and it is the first day of the month. So historically, we see money flows coming into the beginning of the month. And so normally we would expect the market to rise in the beginning of the month. So we'll see whether or not that plays out. Usually the first couple of days of the trading month, very strong. Excuse me. Even the next few days after that, we tend to be pretty strong, really through about the 6th of calendar months. But the real strength comes in the first couple of days, which would be today and tomorrow. Tomorrow we have a big ADP employment report. And then on Friday, of course, the more widely followed non-farm payrolls. We're going to have CPI, some more inflation data coming out here in the next week to 10 days or so. So we got a lot going on, and we'll see whether or not the market can sustain this move to the upside. My guess is we go back down again one more time. That's my educated guess. I do think it's possible, just like I thought back in March, maybe the bottom is in. We have hit the 20% threshold now on the S&P 500, so we did make it official. It is a cyclical bear market. Maybe that's it. The strength in this rally is suspect at best, though. So we'll take a look at that here in just a couple of minutes. But yeah, I mean, we're starting off a new month. Honestly, I would just like to get through the summer months. I think the summer months could be challenging, as they typically are. And then we'll just have to kind of go from there and see what happens into the fourth quarter. I think the fourth quarter is going to be a very strong one, but we'll see. Crude oil prices this morning up $1.50 a barrel, back up over $116. I'm going to show you a chart on crude oil. Big reversal yesterday in crude. So we'll see whether or not that sticks, and whether or not we get a little bit of pullback in crude oil prices. But the fact that crude oil has closed over $115 a barrel, one of those things you better keep an eye on, because crude oil prices, as they rise, I don't know that they're a long-term issue, but short-term, I do think that the market reacts to crude oil prices rising. It's already, the consumer's already pinched. So as crude oil prices rise, that's just adding to some of the difficulties there. Anyway, let's take a look at, for those of you that are new anyway, I'd like to take you over to Earnings Beats. I always like to start off, let everybody know where we live. We live at earningsbeats.com. That's our address. You can find us over here. If you scroll down, we have a free newsletter, the Earnings Beats Digest. I publish that 3 times a week. Just published one just a few minutes ago, talking about an energy stock that looked like might be ready for a pullback. We'll see. Anyhow, name and email address is all it takes. So type your name, email address, hit that subscribe button, you're set up. This is a completely free newsletter, no credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. We really do it just to try to help educate and show everyone the way we approach the market, some of the things that are important to us: earnings, relative strength, candlesticks, volume, trend lines, moving averages, all of those types of things. Obviously, price and volume, big component of what we do. But all of that is discussed from time to time in the newsletter. Also, if you're part of our newsletter, we have free events quite often, and we reach out to everyone on our EB Digest newsletter for those free events. We'll send out room instructions. So it's a great way just to further your education, maybe pick up a few tips that maybe you hadn't thought of before. But it's a way for us to give back to the community that has supported us over the years. So we love to do it. And again, all it takes is a name and email address. I was talking about some of the things that, I'm kind of worried about here in the near term, and some of the things that are maybe not going quite as I would expect when the market goes higher. I'll show you one you might not even have thought of. But right here, we keep track of our portfolios. And every 90 days, we come up with a new portfolio and we track it. Each portfolio has 10 equal weighted stocks. So they each represent 10% of the portfolio. And you can see the portfolio results here. So here's our quarterly performance so far this quarter. Now, it's not calendar quarter. So when I talk about this quarter, we've got that asterisk there. It started May 19th. Now, if you were in that session, if you remember, we were looking mostly at defensive areas. We have very, very few stocks in the aggressive areas of the market. So not much in the way of technology, consumer discretionary, or communication services. We have a bunch of healthcare, a bunch of consumer staples. The whole idea here was, and there was a little caveat that, hey, we might switch out these stocks at some point during the quarter, which we've never done yet, but we may do it simply because I think when this market rotates and really starts to move in the other direction, we want to make sure we're well positioned for that. But when I was looking at this, and I meant to mention it on the weekend in the weekly portfolio report that we send out to our members, usually every Sunday morning. This week it was a holiday, so it went out on Monday. But we're taking a very defensive approach in our portfolios right now. And what I find interesting is that with this huge move up that we've just seen, if it was a move back towards a lot of growth stocks, we should be badly lagging the S&P 500. And I couldn't help but notice that 3 of our 4 literally are almost exactly with the S&P 500 right now. And I actually think that's a bearish signal for the market, because we're trying to, in an up market, I would think we would badly lag, especially if money is rotating back to growth. It was more designed for, in case the market keeps going down, we don't want to get hit like many growth funds have been hit this year. And in fact, our model and aggressive portfolios for the year are way ahead of most growth funds, because we recognized back in February when we did the previous portfolio draft and filled out all of our portfolios, we already realized that we were in potentially a cyclical bear market. So we took some precautions there. We've just taken some more precautions. So on a year-to-date basis, we're not trailing the S&P 500 by a whole lot, which most growth funds can't be said. You can check out the ARK funds or the IBD 50. These are very growth-oriented funds that have really struggled this year because of the movement away from growth. But anyway, I just wanted to point this out. I thought it was kind of interesting with our makeup in our portfolios, which is much more defensive than usual, that we're actually keeping up with the S&P 500 during this rally. And that makes me think not very good things about the market, because we don't have the Teslas and we don't have the Apples and we don't have the Zooms and those companies, that have made these big moves. And yet we're keeping up with the S&P 500. I don't know. It just makes me wonder a little bit about this rally. Anyway, let's talk a little bit about Tuesday. So the Dow Jones Industrial Average was down 0.2%, 223 points. S&P 500 down about the same percentage, 26 points. NASDAQ down a little less, only about 0.4%, but also down around 50 points. Mid caps down 25, small caps down 13. That's where on a relative basis, we saw a bit more weakness, little over 1% on small caps, mid caps right about 1%. Leadership, the only sector that was higher yesterday was discretionary. And that helps because discretionary is heavily weighted, one of the more heavily weighted sectors in the S&P 500. So that's at least a good thing. We had discretionary performing pretty well, although it finished off of its highs of the day. But the other 10 sectors were all down. Nothing crazy, but materials down 1.5%, energy 1.5%, utilities down 1.3, almost 1.4%, healthcare down 1.33%. So, I mean, we're not seeing the aggressive groups down there. So that's good. There's, in those four that I just read, there's no technology, obviously no discretionary. That was a strong group. Communication services not in there. Financials and industrials not in there. So the selling that took place yesterday was mostly materials and energy. So you could chalk that up to some profit taking. Both groups have been pretty strong of late. And then defensive groups. So I'm kind of getting all these mixed signals. So yesterday's action wasn't too bad, but the overall rally hasn't been that great. And I will show you a chart in just a minute that maybe at least make you think a little bit, or something you can watch here over the coming days. Before we get into that, though, let's talk about the 10-year Treasury yield. We do have a couple of economic reports to talk about. First, we got the May PMI manufacturing out this morning. The estimate there, 57.5. May ISM manufacturing, 54.5. And by the way, April for the ISM manufacturing was 55.4. So we're looking for that manufacturing number to drop. Looking in our rear view mirror, April construction spending looking to rise 0.4%. March rose 0.1%, but we're in June. So the market prices things that are coming in, ahead. So what happened in April construction spending probably doesn't matter that much to the market right now. Market knew a while back that we would be seeing construction spending slow. So the fact that now we're seeing construction spending slow, and it's in our rearview mirror, the market doesn't care. Market cares about what's going to happen in August, September, and October, and into the rest of the balance of the year. That's what we're going to be pricing in. And that's why I believe at some point over the next couple of weeks to couple months, I mean, it could be in June. We could maybe see one more move down. Got a couple big inflation reports coming up. Fed meets again later this month. This could be a month where maybe we fall back and go down one more time. And then I'm thinking we're getting really close to a bottom. If we haven't already established it, I think we're getting close in terms of time. So I'm talking about, September, I think at the latest, we're going to have a bottom in. Could be June, maybe sometime in between. We'll just keep watching the charts. Charts will help tell us. S&P 500 yesterday, a little bit of a pause. Good news, though. We broke through the 20-day moving average. We held it. We've had this rally into the end of May, which historically is what we do at the end of May. In fact, a lot of times folks will say, well, what about go away in May? And I always say, just to blindly say go away in May, I think is a big mistake. May through October clearly does not have the performance that November through April has. So there's definitely truth to the go away in May theory. However, I wouldn't just blanket go away in May. The end of May tends to be very strong. The beginning of June tends to be very strong. That's a bullish period. I wouldn't necessarily want to be away during some of these big periods. As I pointed out in our historical trends webinar last week, the truly bearish period in the stock market historically is July 17th close through September 26th close. July 17th to September 26th. Mark your calendars. Doesn't mean we go down every year. We're talking about tendencies. We're talking about history. It's not go away in May. It's fly in mid-July. I don't know, come up with something. That's when you should be much more cautious. Historically, the annualized return from July 7th or 17th close through September 26th close, the annualized return on the S&P 500 since 1950 for that period is minus 2%. The annual return, average annual return on the S&P 500 since 1950 is 9%. So during that period, it's about 11 percentage point. We come up about 11 percentage points short of the average. And that's going back to 1950. And that's a lot of days. July 17th to September 26th. That's over 2 months times 72 years. That's a lot of months. It's a lot of trading days. So we need to be aware of that. But that's the true go away period if there is one in the stock market. So let's take a look at the S&P 500. And I want to show you the ratios, some of the ratios I like to follow. And I'm pointing this out to our members all the time. I mean, this is something I look at. This kind of helps guide me. I know that from a long-term perspective, these ratios are in great shape. From an intermediate term perspective, looking back, say, over the last 6 months, they are not so great. And in the short term, they are pretty good. And I'm talking about the last week or so as we've been rising. Here's the S&P 500. This is a 15-day, 10-minute chart. So each one of these candlesticks is 10 minutes. So there's one day, there's one day, here's one day, and this goes back 15 days. Now at the bottom, you can see, we're coming off, I don't know, 23rd, 24th, something like that. We're coming off of this bottom, moving up. This is one of the key ratios, in my opinion, in the market. The XLY, XLP just tells us discretionary versus staples. It's a great ratio because it highlights an area of the market that sells us the things that we want, which are discretionary stocks, versus an area of the market that sell us the things that we need, which are the staple stocks. So staples, most of the things that they sell, we're going to pretty much buy the same amount no matter what the market is. Discretionary stocks, though, are the types of stocks that are going to sell us the things that we want when we feel good about things. If we're hunkered down in a recession, we're going to probably give up a lot of discretionary items. We don't need them. We just simply want them. But in a good market, when the stock market is feeling good and the economy is strong, then usually discretionary stocks are going to sell more of whatever it is they sell, whether it's cars, whether it's houses, whether it's lattes, at Starbucks. You're normally going to sell a lot more of the things that people want in a good environment, or when the market is anticipating a good environment. And so that's why we want to follow this ratio. I think it's probably the best ratio to follow. I look at a lot of intermarket relationships, and I would say this one is my favorite one for sure. Anyway, right now, as we're going up, XLY versus XLP doing really well. S&P broke above these prior highs, so did the XLY versus XLP. So everything looking pretty good here so far. Let's keep scrolling. QQQ versus the spider. So this is just a look at growth. A lot more growth stocks in the QQQ, which is the ETF that tracks the NASDAQ 100. There's a lot of growth stocks in the spider, but there's more value-oriented stocks in the spider. The spider, SPY, is the ETF that tracks the S&P 500. So the S&P 500 is much more diversified than the NASDAQ 100. And it also takes into account many, many, many more value-oriented companies. Another thing about the NASDAQ 100 is there's no bank representation. There are a couple of stocks that have some financial, belong in the financial sector, but not really a whole lot of financial representation in the QQQ or the NASDAQ 100. Anyhow, the way I look at this is growth versus value. QQQ is more growth oriented. Spider's growth oriented, but also a lot of value. So when the market turns more towards risk on areas, more towards growth, that's when we should see this ratio moving up. And normally that's a good sustainability sign for the market. Market's going up, S&P 500 is going up, and the NASDAQ 100 is going up faster. That's good. That's normally a good thing. So, but when I look back, I don't see quite the same bullish setup here as I do on the S&P and on the XLY, XLP. The NASDAQ hasn't gotten back to where it was in middle part, first couple weeks of May. You can see these relative highs up here. And yeah, we're rising, but we haven't even gotten back to those prior. So we're not getting quite the same support here as we're seeing in these other two lines. Then you got large cap growth versus large cap value. Pretty strong still, setting new highs day after day, but not quite, maybe here getting up to this high, but not getting up back to this high. So a little deterioration there. Mid caps. I mean, first of all, look at the mid caps growth versus value turned lower yesterday. All these others went up to new highs. S&P to a new high, XLY, XLP new high, QQQ versus Spider, new high, large cap growth versus large cap value, new high, mid cap growth and small cap growth versus their value counterparts both came down yesterday after very brief rise. And look at where they are versus where they were earlier in May. Quite a bit lower, both of them. So again, just a little bit of crack there in the foundation of this rally. All of a sudden, the small and mid cap growth stocks falling back a little bit on a relative basis. They've been the real big laggards throughout the past year. And they're rolling back over again. Is that just one day? Are they going to pick right back up and shoot higher today? Well, we're going to find out. But right now, I would say that doesn't look great. So some good news. We know money flows coming in. S&P, holding above its 20-day. We can't go back to new lows until the S&P 500 goes back below its 20-day. You can't get down here to these lows with the 20-day starting to turn back up and price action higher than the 20-day. So I would say from a daily perspective, the first big issue for me would be a move and a close back below the 20-day moving average. That's what I would be watching. So if you're riding this trend to the upside, you could keep a stop at the 20-day. That would be a prudent line in the sand. So keep riding this rally. I think if you get up to 4,250 to 4,300, which is where the last two rallies stopped at 4,300, 50-day moving average just slightly below that, I'd be probably thinking about taking my money there and not waiting for a pullback. And then just seeing if you can get through. This could have been the bottom. Maybe we're going to go straight back up to 4,800 this year. By the way, that was kind of my prediction at the beginning of the year. We're going to have a big sell-off first half of the year. Second half of the year, we're going to come back. So we could certainly just go right back up. My gut is that maybe it's 60-40. We go back down one more time, set a new low. So I'm going to say a little more than 50-50 chance. I think that's what's going to happen. But we could just keep going. All right. What else was there today? Oh, I wanted to show you this crude oil chart. So here's crude oil. We got up to $130 a barrel back in March, pulled back, and we've been in this range now, 93 to the low side, 115 top side for the past 2.5 months. And yesterday we got up to 120. I never saw it at 120. It had to have been really early in the day. But anyway, it came back down, closed under or right about that 115 level. It's showing actually 114.67. But today, earlier, as I mentioned, we are up on crude oil right now. We're up $1.86 per barrel to 116.53. So we're trying to continue to push to the upside. The big drop in the market occurred when we had the steep rise in crude oil. That's when we went down and set that low in the middle of March on the S&P 500 right here. Well, right, let's try this one right here. So here was the low on, that was March 7th. There's March 8th. So we put the low close in on March 8th. And if you look at crude oil, that's when the highs were going in on crude oil. And that's why I say in the short term, crude oil moving back up again, trying to break out up again this morning. We got money coming into the market, but what happens when this new money dries up in just, a couple of days? What happens when we get non-farm payrolls out on Friday? What if we get a shocker there? I wouldn't be surprised. Right now, I think they're calling for 325,000, I believe. Yeah, 325,000. April was 428,000. Remember, we had a GDP that was supposed to be positive and was negative. What happens if non-farm payrolls comes in way below expectations? Crude oil prices are going up. Money dries up from, the new money coming in June. I'm not trying to say that the market absolutely going back down. I'm just saying, trying to be real here in the near term. Market's been under a lot of pressure. Yes, this rally feels great. Probably could still use more negativity in terms of sentiment. So we got a lot of issues still that we're dealing with, I don't know that they're all behind us just yet. Although I am sticking absolutely to my prediction that I believe the inflation high is in. That peak that we saw with the March report that was issued in April, that took inflation at the core level. I think the annual core went up to about 6.5%. I think that when we look back in history, that's going to be the peak, 6.5%. And I believe within a year to 2 years, certainly within 2 years, we'll be back down at the 2% rate. Maybe within a year, maybe sometime in 2023. And when inflation's not a problem, there's no pressure to raise rates. So once the Fed begins to believe that inflation's under control, they're not going to just keep raising rates. They don't want to keep raising rates and drive us into a recession, which we probably are already in anyway. But they're going to want to become more accommodative at that point once inflation is in check. And that's why I think we're going to get a rate decrease, if not later this year, sometime in 2023. I wouldn't be surprised first quarter. Okay, let's look at earnings. So we had a couple earnings reports out yesterday. Salesforce.com was one of them. And I can bring up the latest here and just show you where we are pre-market. Salesforce.com up $18, 11%, 178 up here. Now, when we get up to if we can get up to 185, that's about where we broke down from. That's the 50-day moving average. This gap up is probably most of the move, in my opinion, that the stock's going to make. If it can go through the 50-day and get back up above 190, that would be huge. Then we'd be looking at something much more bullish. But until I see something like that, I would be very skeptical of any move up into the 170s to mid 180s. I wouldn't be surprised to see a big red candle or a big black candle where it's filled, meaning that we close below today's open. I wouldn't be surprised, but we'll see how it goes. HPQ, this is one of our portfolio stocks. They came out with their earnings. You can see they look much better. Stock $39.55 right now, so it's not far from breaking out. This one I give a much better chance to, although I'd like to see it open above this resistance, which is over $40. Candle body resistance will be over $40. ChargePoint, CHPT, they reported they're down 0.5%. And then we've got Victoria's Secret up 11%. It's another one been in a downtrend. It's going to gap up somewhere around the 20-day moving average. Be careful. These stocks in downtrends that see gap ups, a lot of times they just sell right back off again. So you want to be particularly careful with those. This morning, got a decent report out of Capri Holdings. And this is, let's see, earnings there, 102 versus 82. Stock up about 6%. This one's above both of its moving averages and looking to open up even higher. I think the 200-day, which failed back in March, maybe that becomes an issue again. So maybe this one could run up to 55, 56. Then we might have to see from there. All right, for your 3 you must see, to wrap this thing up, I am going to give you 3 stocks that will be reporting today after the bell. First one is Viva Systems, software company. Interesting part about this stock is it's been going lower, but the AD line is getting close to a 5 or 6 month high. Is there accumulation in this stock? I don't know. Relative strength is still poor. So, I'm still seeing much more negative on here than positive. But that may be something that's starting to tell us that Wall Street is accumulating. I mean, there's some hollow candles in here, and this is where the AD line's starting to pick up again. So I don't know. If they have a bad report and gap down, we'll see. Maybe they'll rally into the close tomorrow. MDB, another software company. Another one that's been going down. This one, the AD line doesn't look quite as good. Relative to software, 52-week low. Software has been really bad in 2022. So we'll take a look at both of those, see how they come in. Might as well pull up GameStop, right? This is a big one. GameStop, at least for many of lots of traders, they love trading GameStop. But GameStop has a double bottom in play. There's the key resistance level it's got to get through. I don't know. This one looks to me like it could go either way. Specialty retail has not been good at all. This stock has been okay relative to its peers. So we'll see what happens. But those three that I just gave you will be reporting after the bell on or later today. So we'll get their reactions tomorrow. Anyhow, that's it. Market just open. Let's see if we can get a quick update on what's taking place. Yeah, we're having a pretty strong open. Dow Jones up 223. Or excuse me, 233. S&P 500 up 25. NASDAQ up almost 100. VIX down 1.25% back to about 25 and almost just a little under 26. So overall, getting off to a decent start today. Again, first day of June. This is when money comes in to the market. First, second. Typically, the 3 best days of the month are the last day of one calendar month and the first 2 days of the next calendar month. Those are historically, by far, the 3 best days of the month. So we're in the sweet spot. We've got an uptrend in play. Let's watch to see the rotation, though, here over the next couple of days. If we do keep going higher, do we start seeing Wall Street selling some of these growth stocks that have made a little bit of a move, or do they continue to lead? That will be one thing I'll be watching for. Anyhow, continuing to pick up the pace a little bit here on the bullish side. So things looking good to open. Everybody have a great day. I'll be back tomorrow on Thursday at 9 a.m. over at Stock Charts TV for your next Trading Places live episode. So just click at Stock Charts TV at 9 a.m. tomorrow and you'll catch the next show. Have a great day, everybody. Happy trading.